Thank you for joining us for today's Barron Funds Healthcare Update, featuring two of our healthcare-focused portfolio managers, Neal Kaufman, who runs the Barron Healthcare Fund, and Josh Riegelhaupt, who assists on the Barron Healthcare Fund and manages the Barron Small Cap Biotech Strategy. In addition to managing the Barron Healthcare Fund and Biotech Strategy, Neal and Josh are senior members of our healthcare research team. In this capacity, they work with many of the firm's portfolio managers in covering a sector which makes up a rather significant portion of our firm's total assets. My name is Glenn Smith, and I'm the National Sales Manager of Intermediary Sales at Barron. I'll be your moderator for today's call. Before we do get started, I just wanted to highlight some impressive accolades and statistics which Neal and Josh have achieved while managing the Barron Healthcare Fund. Effective March 31st, 2023, the fund boasts a 4-star overall rating from Morningstar, ranking in the 11th percentile of its trailing 3-year time period among U.S. healthcare funds. To provide additional context, as of the same time period, 3/31, the healthcare fund has returned 14.72% annualized over the last 3 years, outperforming its benchmark Russell 3000 Healthcare by 87 basis points on an annualized basis. The fund has continued to generate alpha throughout this market cycle while exhibiting lower volatility than the category average, according to Morningstar. These are certainly impressive results. With that, Neal, why did the healthcare sector underperform in Q1? And can you share a brief update on the sector, please?
Sure. So healthcare underperformed the market in Q1 for a variety of reasons. First, there was a rotation out of last year's outperformers. And then there were some sector-specific headwinds, mainly in managed care and pharma, large cap pharma in particular, and mid-cap biotech. So let's start with managed care and talk about why those stocks were down in Q1. First, Medicare finalized Medicare Advantage audit rules, which will result in Medicare collecting overpayments to Medicare Advantage plans. This was an overhang throughout the quarter or early in the quarter, but for each company, we think it's going to be a small and manageable impact. Second, Medicare Advantage rates for 2024 were set below expectations. The initial rule with the rates in early February was viewed very negatively by the market, and then the final rates, which came out early in April, were slightly better, but still lower than in recent years. Third, it appears that the PBM industry is the subject of political attention again. We think that with various proposals targeting the PBM industry, and many managed care companies have internal PBM segments. We think companies with PBM businesses can adjust their businesses to manage through, and it's also possible that legislation won't happen, but we reduced our stake in Cigna during the quarter, which has a meaningful percentage of its earnings from its PBM business for that reason. And then lastly, earnings. Managed care stocks reacted negatively to earnings because it appeared that companies were hitting their numbers by dipping into the reserves. That there was a lot of focus on that. But we think at this point, managed care stocks have overreacted to the downside and valuations are very compelling. Turning to the pharma sector, pharma stocks also underperformed in Q1. Again, these were strong stocks last year, and there was rotation out of last year's winners. In addition, investors are starting to think about the impact of the drug pricing provisions of the Inflation Reduction Act. And finally, mid-cap biotech stocks underperformed due to concerns about biotech funding and access to capital after the Silicon Valley Bank crisis.
Thank you, Neal. Josh, we're hearing a lot about Medicare these days and drug pricing. Can you share an overview on what's happening there between Medicare and drug pricing, how all of it works, and how it's going to impact drug pricing?
Thanks, Glenn, and nice to see everyone. Yeah, it's an interesting time. For the first time in the history of Medicare, there will be drug price negotiation. It's not necessarily clear if negotiation is the right word. It's really more maybe drug price setting. I'm going to, the best of my ability, explain what's going on, but the truth is that we don't actually totally know. So we'll kind of go with what we know, and this will evolve over time. So the context here is in August of last year, of 2022, when the Biden administration got the Inflation Reduction Act passed, part of what was stipulated was related to this Medicare drug negotiation. So at the most basic level, we'll talk about the drug part, but there were reforms to a couple other parts that we'll kind of gloss over. But starting in 2026, so that's 2.5, 3 years from now, the highest spent drugs in Medicare, and these are published annually, will be up for negotiation. So this will start with 10 drugs, and this will start in the Part D, as in David, segment of Medicare. And think of Part D as pharmacy dispensed kind of pills, the oldest form of drugs, which you make in a test tube via medicinal chemistry. And then in 2027, there'll be another 15 drugs negotiated. In 2028, there'll be another 15, but the change in 2028 will be that Part B, as in boy, will be included with Part D. They'll now all be combined, and Part B includes all the infused drugs, kind of like the antibody drugs that most people think about. And this will kind of continue. And so, billions of dollars in revenue are going to be negotiated over. So how will this actually work? We recently got publication of these guidelines. In September 1st of this year, the Secretary of HHS, Health and Human Services, will publish a list of the first 10 drugs and for negotiation in 2026. So we'll send letters to the pharma companies, essentially. And then every subsequent year, it'll be on February 1st, 2 years before. So what does this kind of mean? What's the nuance of this? And there will be no test after this because it's going to be detailed. But essentially, oversimplifying a little bit, small molecule drugs will now have about 9 years on market. So the orals, the pills we're talking about 9 years on market. And the biologics will have about 13 years on market. And then Medicare can say, your price was $100,000 a year, it's now $50,000 a year. I'm making those up, but that's maybe a framework. It is strange, and there isn't really a cohesive defense of why small molecule drugs and biologics have different lengths of time. It seems like the politicians actually think that biologics are just more sophisticated because they're a later generation of drug. I certainly am here to tell you that I don't view them that way. Both modalities are important. Both modalities have advanced substantially from what they were historically. And I think rationally as voters, you all potential voters, you would want both timelines to at least be even, 11 and 11 or something like that. We certainly don't want a Medicare medical system where everyone needs an infused drug, where you have to go to some infusion center, you need a nurse, you need monitoring potentially. Pills and pharmacies in some ways are much better. So there are lots of exemptions in these rules. Many orphan drugs, so rare diseases, will be protected. Low spend drugs have certain exemptions. Anything from plasma, so if you are a patient who gets infusions of immunoglobulins, that wouldn't count. Cell therapy drugs would probably not count. Gene therapy, gene editing would probably not count. There's these small biotech exemptions. So if you're a biotech company who makes all of your money from one drug, that wouldn't count. So, it gets very nuanced very quickly. And so we'll kind of gloss over some of those details. But the CBO, the Budget Office of the government, has published their estimations. This is apparently will save about $286 billion. We'll see if that proves to be true. Certainly, the last 10-year publication that we just recently got updated was an overestimate in terms of what drug spend will be. So we'll see if this estimate replicates that. But I'll get back to you in about a decade. So then there's an interesting question. What happens if the pharma companies or the biotech companies say, no, we just won't accept your price. We won't give your drug away. So the government would impose an excise tax. The excise tax is actually the part of this legislation that is constitutionally questionable or legally questionable. Probably the first part of this, or one of the parts that will likely be in the judicial system at some point. It's also very tricky to think of. So the excise tax we know will probably be more than the revenue the company would have generated even before this Medicare negotiation. So it'll be a real burden. But it'll be interesting to see how this plays out if one of the pharma companies essentially calls the government's bluff, for lack of a better word. You can imagine a world where a pharma company would get rid of, say, Eliquis, a blood thinner that lots of elderly patients take, and they run TV commercials on Sunday morning when they're 60 Minutes. And it says, well, I'm sorry you're not getting Eliquis. It has something to do with Medicare. You should probably contact your local representative and your congressman and tell them that you want your drugs. And you have to remember some of the context here is that this bill was pushed through mostly by the executive branch with not as much deliberation in the Senate or the House. And so that would kind of make all these things come into question again. And recall 2026, we're going to have a whole new government in place. So very, very hard to kind of do those predictions, but it is very clear this is here. It is very clear that the way Medicare works is going to change. Now, I'm going to give you one last piece of interesting context, which is how this kind of is political but less impactful economically. So currently, Medicare is about 66 million enrollees. 46% of those, or about 30 million, are in what's called Medicare Advantage. So it's Medicare that's administered by United Healthcare, commercial insurance, United Healthcare, Humana, Cigna, whatnot. Those drugs in those plans are already negotiated. So it's unclear exactly what more would be negotiated. It probably will be some more, but is it 10%? It's not going to be as drastic as I just mentioned because it already is reduced. So global drug consumption is rest of the world. We think of that as kind of half of all drugs, US half, and then rough math, half is Medicare, half is commercial. So if already a large slug of Medicare is negotiated, and that's growing, by the way, it's expected to get to about 60 to 70% by the end of this decade. How much is really being negotiated over? How much is this really impacting the change? In some senses, maybe it isn't as much as it sounds like. And so it's a change. It's good. I'm totally okay with there being more rationalization in terms of the drug markets, but it probably sounds a lot scarier than it actually really end up being. And we'll keep monitoring it. We'll probably update you. Probably not next call. We'll probably wait a year, well, maybe till September. We'll see some of the drugs that are out. We'll comment on it, and then we'll kind of update you as it goes along. All right.
Thanks, Josh. Neal and Josh, what have been some of the bright spots within the healthcare sector to start the year?
Sure. So on the positive side, medical device companies are starting to see a strong recovery as some of the COVID pressures start to fade away. So there have been, over the past couple of years, there have been labor shortages in hospitals, and procedure volumes have suffered, but we're starting to see that lift. So medical device companies like Intuitive Surgical are reporting very strong results for Q1. Intuitive Surgical reported 26% year-over-year procedure growth in Q1. Other medical device companies reported very strong Q1 results. Hospital companies as well are also reporting strong results. HCA, which is in the fund, last week reported very strong volumes, revenues, and EBITDA. There's also another bright spot is M&A activity. One of our recent additions to the fund, Prometheus Biosciences, it was recently announced that Merck is going to be acquiring Prometheus at a very big premium. Josh, do you want to talk a little bit about Prometheus?
Yeah, very briefly. They have a drug for ulcerative colitis or Crohn's disease. It's a part of irritable bowel disease. It has best-in-class efficacy. It's the first ever drug in this type of GI, gastrointestinal disorder, that has any form of genetic biomarker. And so it already has best-in-class efficacy, and then potentially the patients who you identify with this biomarker for something called TL1A might even have higher responses. And so it's a bad disease, and hopefully these patients will will benefit from both continued drug development and Merck's stewardship of the asset.
So Merck announced it was acquiring the company at $200 per share. The stock was trading around 114 prior to that announcement. So it was a nice gain for the fund. Two other names in the portfolio have recently also become subject to takeover speculation. Dechra Pharmaceuticals, which is a company in the animal health space, and Shockwave Medical, a medical device company which sells products that use sonic pressure waves to treat calcified plaque in the arteries. They're both rumored or reported to be subject to takeover attempts.
Excellent. Thank you both. Shifting gears for just a second, can each of you highlight a stock that you're excited about right now?
Sure. I'll talk about Dexcom, which is a stock that we've held in the fund for many years. It's a medical device company which sells continuous glucose monitoring devices for people with diabetes. They're in the early stages of launching their 7th generation device, which is called the G7. The G7 has many new features. It's smaller, 60% smaller than the 6th generation G6. It has a disposable transmitter, which is a huge improvement versus the G6, which required wearing the transmitter for several months at a time. And there's 30-minute sensor warm-up, which is industry leading. And then there's some other features as well. We think the G7 is going to drive revenue growth acceleration for the company. They still have an opportunity to continue to penetrate their core insulin-intensive diabetes population around the world. In addition, Medicare has decided to cover or provide coverage of CGM for people with type 2 diabetes who are basal insulin users. This means people with diabetes who use insulin daily. They don't necessarily need to use insulin intensively at every meal or multiple times daily, but this expands the market opportunity for continuous glucose monitoring and adds a few million patients to Dexcom's addressable market. Over the long term, we think that Dexcom will have an opportunity to expand into the even larger category of non-insulin users with type 2 diabetes, given that there are proven benefits of using CGM to help all people manage their diabetes.
All right, thanks, guys. And I'm going to talk about a company called Rocket Pharmaceuticals. So they are a developer of gene therapy, specifically for non-oncology. And that's in kind of contrast to the beginnings of gene therapy, where a lot of the efforts were in more oncologic spaces. So they are working in cardiology and hematology. I will not say the diseases they're working out loud, as they're very confusing, but they are 3 of them all clinically de-risked, with commercial launches expected between 2024 and 2026. So we kind of expect billions in revenue by decade's end for a company that's currently valued at about 1.5 billion in market cap. So bigger picture, it was worth noting that genetic medicines, and in particular gene therapy, as a space over the past kind of 12 to 24 months were notable underperformers. So, shares across the board were down 60, 70%, and this kind of piqued our interest to go looking for investable ideas where we thought there was lower risk, biologically speaking, for a drug developer. So when you think kind of about gene therapy in general, it isn't biologically risky to look at a genetic disorder that has, a mutation in one gene that's making one bad protein, and to try and insert something that replaces the gene, which then replaces the missing protein, and to convince yourself that rationally, if you have a misfunction that causes some disease, when you put in a healthy copy of the same protein, you're probably going to end up with improvement for the disease. I mean, it's very simple. So that part feels pretty straightforward. The much bigger risks in some sense are commercial risks, in that gene therapy is very new to the healthcare system. Imagine yourself even. How would you feel about the risk reward of getting a one-time infusion and then knowing that this drug was inside of you for quite a long time, or that you couldn't just stop taking the pill and it would go away? Now, if you were dying of something, which is how this is all starting, you wouldn't really think much about that. You would do it. But, there's a transition period, certainly. There's also the question of how insurance companies or payers will deal with this. Do you pay all at one time? If you take a 15-year-old and you infuse them with a gene therapy, will it work for 65 years? How much is that worth? How much is the value of a human life? And, if you go to England, they'll sell you it's $50,000 a year. And if you go in the United States, they'll tell you it's worth $200,000 a year. And then if you really ask anyone out loud about this, they'll tell you that it's discrimination, and then you can sue on that. So it's pretty tricky to determine exactly how that works. But the good news is Peter Marks, who's probably the most important person in the FDA for these things, is being very public recently about wanting to prove the gene therapies because of the biology I mentioned before. And this is all kind of pushing forward very quickly. So we kind of had this trough in the past 2-3 years, and it's really kind of picking up. So it makes it very interesting. Bringing this back to Rocket, the company we're interested in, their most important disease is something called Danon disease. It's a disease where your heart grows anywhere between 2 to 5 times the size of normal. So it affects boys between the age of 10 to 20, girls between the age of 30 to 40, and they're at risk for sudden death. I mean, they have quality of life issues and lots of things go wrong, but they're a constant risk of sudden death. So, I'll pose to you, if you yourself, the audience, have ever known someone who just kind of dropped dead at a very young age from a heart attack that no one could explain, there is a possibility that it was just an undiagnosed case of Danon disease. In a world where prenatal testing, general genetic testing is going to continue to go up, we will likely be catching these cases. There's estimated to be between 20 and 40,000 patients in the US and EU now. And hopefully, as we progress, we can treat these patients and spare their lives.
Wow, thank you, gentlemen. I can see why you're excited about both companies, the expanding market and the innovation that they're driving to treat some of these really terrible diseases, frankly. What are some of the key messages you'd like our investors to take away from today's call?
The key message is that even though healthcare is off to a slow relative start in the first quarter, we think it's a good time to be investing in the sector. Healthcare offers the opportunity to invest in innovation and growth, while also offering defensive characteristics and stability in the event of a potential economic slowdown. We feel good about how the fund is positioned. The COVID headwinds are fading, device companies and hospitals are seeing medical procedure volumes recover, and valuations are compelling in the managed care space.
Yeah, I totally agree. Aging demographics are going to continue to be aging demographics. There's going to be plenty of people who are going to need healthcare. Biotech has the fortune to be part of the technology space, and technology is continuing to improve. As long as computers and compute power continues to improve, it's going to help our space continue to make great strides. In some ways, the human body is the most sophisticated computer, and as our computing power gets bigger and bigger and bigger, we're going to figure out how to navigate the human body better and prevent disease more, and hopefully make everyone live longer and healthier longer. So,
excellent. Well, thank you very much, Neal and Josh. It looks like that's all we have for today. With that, we will conclude today's call. Should any of our viewers have follow-up questions, please reach out to your Barron Funds sales coverage, or you can email questions to questions@barronfunds.com. Please note a replay of today's Zoom call will be available on our website at www.barronfunds.com. I want to thank Neal and Josh for their comments, as well as all of you for listening today. Most importantly, I want to thank you for all of your support of the Barron Fund family. This concludes today's call.